Joining us now, Richard Bernstein Advisors Deputy CIO Dan Suzuki and PIMCO Portfolio Manager Erin Browne. Good morning to you both. Dan, I'll start with you. Given the moves and the gyrations we've seen in the market in recent days, the Dow closing on Friday to make a new 2022 low, the S&P and NASDAQ flirting with those June levels as well before bouncing today, does the market have its arms around a tighter for longer Fed?
Yeah, it's a really good question, Morgan. First of all, it's great to see you again. Glad to have you back on the set. Yeah, I think, that part of the story, the market has largely gotten their head around. I think the bigger concern for me going forward is that the part of the story that the market really hasn't wrapped their head around is that, growth is probably going to continue to slow and is probably going to disappoint relative to expectations. So the transition from, the tightening Fed story to the slowing growth story, I think that we're kind of in that transition right now, and that's where a lot of the second, the volatility from here, could bubble up from.
Erin, how do you see the market right now and the levels that we've been moving around and where we go from here?
I think that the market has discounted some of the financial conditions tightening that we've seen year to date, but certainly I don't think not enough. And, you look no further than looking at earnings estimates for next year, and they're still quite lofty at up around 10% or close to 10% on a year-over-year basis. And so the market still is anticipating a pretty strong back half of next year, which I think is premature to expect. I think the market's still expecting that the Fed could start to cut middle of next year, which we think is probably likely premature in terms of the market's positioning and thinking. And so with that, and with financial conditions likely to prevail at tighter levels, I still think that the market is too complacent about the outlook and that the risks still are on the horizon for weaker equity prices from here.
That's interesting. Dan, I wonder, in terms of tone on the Q3 earnings calls, we've already processed FedEx and a lot of the chemical warnings and GE and what Target and Walmart said about consumer a couple of months ago. What do you think they could say in Q3 on the calls in terms of commentary that would be surprising or incremental?
Yeah, Carl, I think it's going to come down to, that guidance that's going to come from the companies as they talk about, not the trends, for what we've seen over the last few months, but what they're expecting over the next few months after that. And I think, those guidance numbers will come in pretty weak, most likely. The question for me is, it's really not so much about, this quarter's earnings. I think it's possible that you get a situation like you saw in the second quarter earnings season where, the market's braced for really bad news. They got that bad news, but there wasn't, a huge reaction, through earnings season on the back of that. It's possible you get some of that, to your point, a lot of the bad news, we've heard a lot of, foreshadowing of bad news from FedEx and whatnot. But I think the question is, this quarter's guidance, the next quarter's earnings season and their guidance and the quarter after that are probably going to continue to slow and continue to disappoint. And so that trend over the next 6 to 12 months is going to be the bigger headwind for markets. I'm not sure necessarily, if the market's already braced enough for this one earnings season.